Hey, thank you for joining. About 3 weeks ago, towards the end of May, I did a video, a whole series of videos actually on Zoom. We had several hundred people in the audience, and many of those attendees have asked me to re-record it and post it on YouTube. So I recently did add a new YouTube channel. It's called Stephen Invests in Distress. And I'm going to recreate much of what we talked about on that video. The primary focus of it is simply this, that our economy seems to be doing extraordinarily well, but my belief and the belief of a lot of other much more intelligent men and women than I is that we've got a lot of issues associated with the economy. Primarily, as you can see, we tend to think that we're in the middle of a bubble. And so let's first talk about the definition of a bubble. First off, a bubble is an economic cycle that's characterized by the rapid escalation of market value, particularly in the price of assets. So how does that apply today? Well, if you look at pretty much any asset class, whether it's single family homes, whether it's the equity markets, whether it's used cars, which are up almost 100% over the course of the last 12 months, whether it's, virtually any commodity, including lumber, which is up over 300% over the course of the last 24 months, there are bubbles, and those bubbles are dangerous. We see in our economic cycles, which occur roughly every 7 to 14 years, we see declines and we see growth and we see collapses or deflation of those bubbles. And we'll talk about that a little bit later today. But fundamentally, our concern, and it's not broadly shared, and that's kind of the intent here, is to pictorially and using graphs show you why we think those bubbles exist and what the potential downside looks like. So again, getting back to the notion that we're in a bubblicious economy, bubbles created by a surge in asset prices that is driven by exuberant market behavior. Exuberant market behavior, that implies in and of itself that bubbles are consumer driven, they're psychological and sociologically based, which I'm certainly a fan of. Robert Shiller invented this notion of excessive exuberance, or he coined the phrase in the early 2000s. It was eventually sort of branded by Alan Greenspan, who was the Fed chairman at the time. And it just essentially talks about how it's that fear of missing out. It's that need to participate in a market regardless of what that market is, whether it's the equity markets like it is today, whether it's the single family housing market back in 2008. People had the distinct need to participate in that increase in demand, given a limited supply, is one of the things, a primary driver behind the bubble and the bubbles I think that we're experiencing today. So let me go to another graph here. What causes these bubbles? First off, this right here. This is known as the M1, or the money supply. If you look at this chart, it goes back to 1970. You see a steady increase in the money supply. And the money supply, by the way, is a function of a variety of things, including how the rate at which banks lend money, but more importantly, the Federal Reserve and how much new capital they put into the marketplace. And we know, as a result of the stimulus programs out there, that between the Treasury and the Federal Reserve, monetary supply has increased dramatically. So let me specifically show you what I'm talking about here. Between, call it 1970 and 2008, we saw an increase in the money supply. It went from about just over $1 trillion. Just over $100 billion to somewhere just below $2 trillion between 2008. And as a means to continue to support and prop up the economy and help its recovery in 2010 and beyond, we saw that monetary supply almost double from just under 2 trillion to just under 4 trillion. Here's where it gets really interesting. If you look at that monetary supply, M1, it's gone vertical in such a fashion as this country, this world has never seen happen before. It went vertical, and we went from 4 trillion outstanding to somewhere around, I don't know, what's that number, 19.5 trillion, all in the course of less than 12 months. So this right here, this massive influx of liquidity into the marketplace is what drives bubbles. If you look at bubbles, there's two components to any economic situation. There's demand and there's supply. Demand needs to be supported by the ability to execute. In other words, somebody has to have the money either in cash in their pocket or access to debt or a combination of the both to be able to execute on that demand. Without the ability to execute, that demand really isn't part of the equation. So what we've done here is we've put trillions of dollars into the hands of consumers and business owners. And remember that here in the US economy, 60 to 70% of our gross domestic product, in other words, our economic output, is consumer spending. And so what have we done? We've enabled the consumers to a degree never seen before, and business owners to a degree never seen before, to spend like there's no tomorrow. And that spending, given limited supplies of whether it's cars, whether it's houses, whether it's equity, whatever, we've driven prices through the roof. And the question becomes then, is this stuff sustainable? We'll talk about that in a little bit, but look, this is an economic experience, an experiment that we've never seen anywhere in the history of man that I'm aware of. Weimar, post-World War I in Germany, but that was completely different for a variety of reasons. So M1, primary driver. Corporate debt has also increased dramatically to the point where we've influxed so much capital into corporations that they have been on a buying spree and a growth phase that they literally, again, have never experienced before. And that's occurred essentially since 2000. 2000 was where we entered the dot-com bubble. Since then, we've seen outstanding debt for corporations more than double, from somewhere just around 3 trillion to north of 7 trillion. Huge driver behind bubbles. Margin debt. So when we talk about equities, the Wilshire 5000 index is a combination of all outstanding corporate equities, whether it's the Russell, the Dow, the NASDAQ, or the SPY. All of those corporate equities that are outstanding are reflected here in the Wilshire 5000. The other line that you're looking on this chart is margin debt. In other words, it's money people borrow against their equity portfolio and positions to buy more equity. In other words, it's leverage. We are seeing equities and margin debt at all-time highs. Now, the problem with that is that when the market retraces, and the market will retrace, cycles occur. This time it's not different. It's going to be the same as every other cycle. We'll correct, and we'll probably likely overcorrect, and we'll talk about that here in a minute when we look at the Buffett indicator. But when we start to correct, with this level of margin debt, that correction is going to accelerate, because we're going to have to, or these investors, these various investors, including hedge funds, are going to have to liquidate assets that are performing, whether it's gold or consumer staples or whatever. They're going to have to liquidate solid positions to cover their losses on more speculative positions. So yeah, margin debt is a potential problem. Again, debt is debt though, and it accelerates historically bubbles. The other thing that's a major contributor to bubbles is debt, which we just talked about, but cheap debt specifically. This that you're looking at here is a chart going back to 1960 of both a 3-month treasury bill, which is it's an index that's used to price certain debt instruments against, and the 10-year treasury constant maturity. If you look at these numbers, what you'll see over here is that we're at all-time lows. And that two things occur as a result of that. That's cheap money. That's extraordinarily cheap money. And when money is that cheap, people are going to be borrowing hand over fist, particularly in the face of inflation, which we all know, although it's not well reported, is here today. So you've got cheap debt. That cheap debt accelerates and exacerbates bubbles. The problem, though, is that we have used management of interest rates, particularly the Federal Reserve, to help us recover from economic recessions. But what you'll notice is that given where interest rates are today, there's no room on the downward side. There's no room to reduce effectively interest rates, in part because inflation is already higher as an example, than the 10-year treasury. So if you're investing in 10-year treasuries as a secure vehicle by which you want to place or park some capital, you're losing money on it because inflation outranks or outpaces the rate of return that you're receiving on your 10-year constant maturity. So debt, major factor, accelerates bubbles, but it also can be a beneficial asset for the Federal Reserve. In this situation, the answer is though, no. Federal Reserve has nowhere to go in terms of the downside. Now, fact be told, Federal Reserve doesn't manage 10-year constant treasuries. What they manage is Fed funds or overnight rate by which banks lend to each other. But because they have extraordinary buying power as a result of being able to print money, they're able to buy things like treasuries. And in buying those treasuries, they increase demand. That increased demand reduces interest rates. Functionally, that's what happens. So the treasury over the course of the last, I don't know, it's got to be 16 months at this point, has been spending about $120 billion each month to acquire two things, both corporate bonds and mortgage-backed securities. And as a result of that, and by the way, of course, 10-year treasuries, that's part of our monetization of our debt. But the reality is, this is a problem, guys. There's no place for us to reduce rates and assist a depressed or recessed economy. That's something that we're going to be challenged with deeply. I found this chart and I find it extraordinarily fascinating. If you look at this, this is the GDP versus Wilshire 5000 versus the monetary base. The GDP again is output within the U.S. Essentially all corporate and private company output. Boom, that's what this represents. And you see that it's a fairly consistent but steady incline to the upside, aside from this dip here, which represented by the pandemic we effectively shut down. The second line I want to point out is the stock market. This is the Wilshire 5000. And you'll see that effectively it bounces right off GDP. It gets overvalued, and this is the dot-com bubble, and it retraces down or close to the GDP line. It becomes overvalued again, and this is the great financial recession of 08, and it too retraced all the way down to the GDP line. But since 2008, 2009, this has gone exponential. It's gone not quite vertical, but man, has that exploded. And so if you note the gap between GDP and the total stock market, it's ginormous. And we'll talk about that in a moment as it relates to the Buffett indicator, but man, that's a problem. What's driving that? I'm sure that you could see total monetary base. Monetary base, which is the massive amount of capital out there, driving bubbles, including the stock market bubbles, is pushing valuations to all-time highs. So again, this is an example of how bubbles get created. You put too much liquidity in any marketplace, and you put too much access to debt, particularly cheap debt in the marketplace, and bubbles will exist. So this is probably the most fascinating chart that I'm going to share with you today. It's known as the Buffett indicator. Excuse me. It's value versus historical trend, going back to the 1990s. If you look at the center of this chart, it's the zero line. The two lines above it are one standard deviation, and the lines beyond that are two standard deviations. So what this Buffett indicator does is talk about excess or undervaluation of the stock market. And you'll note really consistently when we've exceeded one and sometimes two standard deviations, there's always been a retracement. And so here we had the 2000 dot-com bubble burst, and we saw a major retracement. Now, what was interesting is that to a very large degree, that pullback in the market was limited largely to massively overvalued, what was known as at the time as internet stocks, the dot-com stocks. So we didn't retrace to a huge degree. Different when we hit the 2008 dot-com bubble. 2008 great financial recession tied to subprime lending in the housing market. So when I say tied to subprime lending in the housing market, you notice that we never really got massively overvalued. We stayed within this fairly valued range. but we retraced to a point where we were massively undervalued. But since then, what's happened? Since 2008, 2009, which was effectively the bottom of the market, we have grown at a pace, again, not seen throughout history. For such an extended period, it's ridiculous. So if you say 2008, 2009 was the bottom, that's 14 years ago. That makes this move between here, the bottom and the top, the single longest bull run throughout the history of the U.S. And that needs to be disconcerting for you simply because, again, economics occur in cycles. And this is the longest bull run cycle that we have ever experienced here in the U.S. We're ripe for a correction. And this indicator right here, and by the way, I'm using a chart going back to end of May or middle of May, simply because that's when I did my first presentation. That's showing us that we're strongly overvalued. When we move into the strongly overvalued category, which is almost 3 standard deviations away from mean, we're ripe for a major retracement, for a major pullback in the marketplace. And I think that's what we're about to see. Yeah, let's skip that. Well, this is, you know what, this is very worthwhile talking about. This was at the time I did the first presentation, this was Bitcoin. And Bitcoin, is pretty much all cryptocurrency, in my opinion, is in a massive fear of missing out bubble. At the time, it was actually trading right around $60,000 per Bitcoin. My fundamental issue with Bitcoin is this. Well, actually, there's a few of them. One, anybody can create a Bitcoin. All they need is access to the internet, a computer that's properly configured, and power or energy. The base cost to create a Bitcoin is somewhere between $6,000 and $8,000. Yet it's trading at 10x that. That's a margin of profit that is effectively unheard of in any other good or services that I'm aware of. It's ludicrous. It's fundamentally, there's no moat. Anybody can create it. There's no barriers to entry to building and creating Bitcoin, which is also a major problem. If you follow any of Buffett's investment strategy, he likes to buy companies that have a bit of a moat. There's a barrier to entry, and there is zero barriers to entry in Bitcoin. Again, I'm no expert as it relates to cryptocurrency, but this is a problem. And it turns out that there's been, over the course of the last 3 weeks, a major retracement in Bitcoin. In fact, I think it fell as low as 30,000. There's still a lot of people that are bullish on it. And they're bullish for a variety of reasons. One, because people tend to lose faith in the dollars. We continue to print massive amounts of new US dollars. And then the other thing is we've got blockchain technology behind Bitcoin. Blockchain is rock solid, but is Bitcoin? Came out the other day that the US government was able to pull back a Bitcoin that they delivered to hackers as a result of, I don't know, it was a colonial pipeline or whatever, but they were able to grab that Bitcoin back. Theoretically, that should be impossible. How does somebody reach into somebody else's crypto wallet and pull that money out? It leads to questions about Bitcoin and other cryptocurrency. This is the Case-Shiller index. I mentioned earlier, Robert Shiller is the one who coined the phrase excessive exuberance. The Case-Shiller indices talks about same home sales over a period of time. And this is effectively what we're looking at. Without going deeply into the numbers, we're way beyond the 2008 highs as it relates to the same home sales. And that's understandable from a variety of reasons, and perspectives, but we're way out in astronomical territory here, guys, and this is scary. Here's the thing I would say about single-family homes and many other bubbles. Household creation hasn't exploded over the course of the last 12 months. What has happened, though, is more cash has been put into the consumer buyer of single-family homes, and therefore they're out buying second homes or expanding their existing homes. And so it's not a function of necessity. It's a function of desire, which is not sustainable demand. Necessity, you need a roof over your house. Request, like I want a nicer home in a better location with more square footage. That's not a driving demand. That's really more of a, well, nice to have. So We're in a housing bubble. There's no two ways around it. Here in Laguna Beach, where I live, home prices increased more than 30% over the course of the last 8 months. That's Laguna Beach, where the average home is selling now for more than $1.5 million. It's ludicrous. What are the things that could cause us to begin retracing and seeing a pullback in the marketplace and essentially deflation of the bubble? See, I don't believe that bubbles pop. They don't pop overnight, particularly for tangible assets like single family homes. They take a while to correct. Prices take a while to correct simply because homes have to trade. And then there's foreclosures, and then there's short sales. And over a period of time, in the 2008 Great Financial Crisis, I think it took over 2 years before we hit the bottom in terms of single family homes. Might have been even 3 years. One of the things that drives that is the inability to access cheap debt. This graph here represents the credit standard and tightening of loan requirements from a consumer and industrial loan perspective. Essentially, what this is telling us is that lenders are becoming much more sensitive in terms of the loans that they put out and who gets to borrow what. These spikes you'll see here in 2000, you saw a major spike, which was the dot-com bubble. Did it create the retracement? Did it create the pullback? Did it create the devastation we saw in a lot of the dot-com stocks? I don't know. I don't think so, but certainly was coincidental and had to be at least a contributing factor. Here, we saw a major spike in credit tightening, and this was immediately preceding and part of 2008 Great Financial Crisis, and then we're seeing it again over here. This is immediately following the 2020 recession, but this is about where we're at. So we see a major increase in credit tightening, and that's got to be a little bit disconcerting. So, yeah, I want to make this really very worth your time, so I'm going to bring it all back full circle. My arguments are that we're in a bubble, and those bubbles are actually everywhere. Just about every asset class that a consumer or business owner needs to pursue as part of their business or part of their leisure, really, at this point. Here's the typical cycle of a bubble. Optimism through euphoria. And this is kind of where I think we're at right now, which is the point of maximum financial risk. And then we see a range of emotions. And at some point, we're going to end up with despondency and depression. This is what I would call maximum capitulation. And then we're returned to optimism. So it's a clear cycle. And this thing is repeating itself and has repeated itself throughout history. So the question is where we're at right now. It could be easily argued that we're in this territory right here, point of maximum financial risk. As it relates to the equity markets, I think I pointed out that certainly there's an argument that says, given that we're 3x the standard deviation, or close to it, I should say, that we're right there at maximum financial risk. And so what do? Well, you consider hedging your position. I'm not a financial analyst, and I'm not trying to give you financial advice, but I will tell you that it might be prudent to talk to your financial advisor and see in what ways you can hedge your position. I'll tell you that going into 2008, I was very fortunate to be able to see it coming, and I traded well, and I made not a great fortune, but we did very, very well. But it was challenging, and I'll tell you the reason why it was challenging. I was one of the few standing out saying the sky's about to fall, and people were saying things like, "Well, housing never comes back, never falls in pricing." And having been a banker, an investment banker, and a major real estate investor for years, decades at this point, I'm very aware that cycles occur in real estate, very much so. In fact, sometimes even greater than they do in the equity markets. So back in 2007, I was doing some trading. I put two of my larger trades on. I sold calls for both First Federal and Downey Savings and Loan, and I bought puts. So I was doubling down in a single direction, which was the stock was going to decline. The reason why was simply this. Those are two savings banks here in California, and instead of offloading their subprime loans and securitizing that debt and pulling in massive profits, what they were doing was keeping those loans on their books because they liked the yield. I knew, and some, again, minds greater, much greater and smarter than mine, knew that that bubble was unsustainable. You cannot keep lending to every Tom, Dick, and Harry who steps along as much money as they want to buy a home, actually put some money in their pocket at the same time. Because at some point that tap gets turned off. And when that tap gets turned off, you massively decrease the buyer pool. And that's going to have a major downward impact on valuation. So the night that I put those two trades on, it was a couple $100,000 trades. Jim Cramer came out on Mad Money and said, hey, if you're going to own any two stocks, pick these. I should say in the savings bank, in the savings and loan industry, pick these two because they hold their own paper and they have great yields and great dividends. And I'm like, you got to be kidding. That is literally the stupidest thing I've ever heard. That night, I think I lost probably $40,000. By the time the market opened the next day, the stocks started trading at 73. When I sold when I put those trades on that night, and the morning, they popped to $77 each, rough plus or minus per share. And that cost me a massive amount, but I didn't close out that trade. I watched those stocks get pummeled, and I think I closed eventually out both those trades at $40 a share, and I think I made, well, good profit. Because I was the odd man out still. I was still that single boy calling wolf when the sky is falling. I didn't stick to the trade, and eventually both those companies went bankrupt. It's true. I mean, it happened also with many other companies that we traded, like Bear Stearns and Lehman Brothers, all holding massive amounts of this paper that was essentially crap. So look, my point here is this: difficult to hold a contrarian position, particularly when the market's moving so dramatically against you, which is one of the reasons why you have seen so many short sellers get out of the marketplace. And by the way, that's not a good thing. Short sellers, when the market falls, have to buy the stocks to cover their position, which in some cases will halt or slow the fall of any given equity. Those short sellers are not in the marketplace in a robust way. They've been chewed up and spit out, given all the stimulus that's gone into the marketplace, given all the fear of missing out, given all the excessive exuberance. So final words of thought for you: be cautious. We are in the middle, or maybe tail end, of the most gross economic experiment that this country has ever seen. Massive amount of liquidity like we've never seen before, and interest rates that are incredibly low. There's massive opportunity here, but there's also massive risks. So invest wisely, choose wisely. Thank you.